Okay, so here we have profit for the year so here we have profit for the year, and this is from Bottle's separate trial balance perspective. Now, to go from separate trial balance to group perspective, we need to ask ourselves, are there any group adjustments? So the only time there will be a difference between profit for the year from the separate trial balance perspective versus profit for the year from a group perspective if there are group adjustments. Now, there are two types of group adjustments, loosely speaking, okay? So the way I think about it is that there are two types of group adjustments. Group adjustments relating to transactions at acquisition, group adjustments relating to intercompany transactions. Okay, so for us, when it comes to Bottle, there is no group adjustments relating to at acquisition transactions, but there are group adjustments relating to intercompany transactions. What's very important to consider at this point in time when you're dealing with group adjustments is whose profit must you adjust? Do you adjust the subsidiary's profit, or do you adjust the parent's profit? So that's very important because that will impact whose profit you adjust will impact the NCI's portion. So that's why it's very important to make sure you're adjusting the correct entity's profit. But I do suggest even so if you're dealing with Bottle and there's an intercompany transaction, but the intercompany transaction do not impact the subsidiary's profit, but rather the parent's profit, then adjust the parent's profit at that point in time. The reason being is that will help you to not need to read the scenario for the second time. Okay, so let's jump back into, go back to the scenario. Let me just switch my screen. Okay, so now we go back to the scenario where we have Bottles. Okay, so they say in the previous financial year, Bottles acquired valuable land to generate rental income. From the date of acquisition, the land was rented to Cooldrink for 11,000 Rand per month. On 31 August 2020, the fair value of the land amounted to 1,145,000 Rand. Now, what's important to take note over here, okay? Remember, we are adjusting profit for the year. So we would most likely want to remove. So what you must understand, because we are adjusting profit for the year, we're trying to get profit for the year. Our starting point, if I just go back over here, our starting point is profit for the year. So you only need to make adjustments that will have an impact on profit. If it does not have an impact on profit, there's no need to adjust. And this is very, very different if we had to start with sales. Because remember, if we had to start with sales, cost of sales, gross profit, other income, other expenses, then we most likely have additional adjustments. So let me just explain what I am referring to over here. When we have a look at the rental income, 11,000 Rand per month, in the books of Bottles, they would have in the books in the income statement of Bottles, in the profit and loss statement of Bottles, in other income, there would be 11,000 Rand times 12. In the parents' profit and loss statement, other expenses, they would also have 11,000 Rand times 12, times 12, okay? So from a group perspective, we have other income that is inflated by 11,000 Rand times 12, and from and other expenses that's also inflated by 11,000 Rand times 12. Now, other income increases profit, other expenses decreases profit, so the net impact on profit is zero. So in this case, we don't need to eliminate the rental income, because the impact on profit is zero. Because if we eliminate rental income in the books of the subsidiary, we'd have to eliminate rental expense in the books of the parent. So the impact on profit is zero. So we don't have to eliminate it. However, if we started the profit and loss statement from sales all the way down, then we would have to eliminate, because we are showing the separate line item other income, we are showing the separate other line other expenses. So that means if we do not eliminate, then other income will be overstated and other expenses will be overstated. But in this scenario, there's no need to eliminate because we're only impacting profit for the year. Very important to understand those subtle differences. So usually we would make this adjustment, but we won't make it now. So the only adjustment we need to make is this of the fair value gain. Okay, so we need to take out the fair value gain. Why must we take out the fair value gain? Because in the books of bottles, the investment property is in the books of bottle, the investment property is, or in the books of bottle, the land is classified as investment property. And so therefore, the fair value gain would go through profit or loss. However, from a group perspective, this land is considered PPE because it's owner occupied. And as a result, because it is owner occupied, we're still going to recognize a fair value, but we're applying IAS 16. Fair value, which is revaluation in terms of IAS 16, is not recognized through profit or loss, but rather it is recognized through other comprehensive income. Okay, so that is the reason over here. So if we go back, the adjustments, group adjustments, I'm just going to make a heading. You don't need to put this heading over here. I'm just putting it so that we understand. Okay, so group adjustments. It's going to be reclassify fair value gain on land. Okay, so included in bottles profit or loss, correctly included, is the fair value gain or fair value loss, whichever one it is, we'll see now. Okay, fair value gain or loss on land, so whichever one it is. Okay, so it's included in there, but from a group perspective, we do not want it in profit or loss because the land is not investment property. The land is PPE. So a fair value gain on PPE, which is a revaluation, is not allowed to be recognized in profit or loss. It has to be recognized in other comprehensive income. Okay, so if we have a look over here, fair value at 31 August 2021 is 1145. And the fair value of the land, where is it, investment property at 31 August 2020 is 1225. Okay, so if we go over here, it is 1145 minus 1225. Okay, so if I put it in, I'm going to say 1145, 123 minus 1225, 123. Okay, so that is, then we do the tax. So remember, you can do the tax in this line item, but I'm going to do it separately because most people find it easier when we do the tax separately. So it's much easier to understand when I show the tax separately. So I'm going to do it that way, but you are more than welcome. If you're comfortable with dealing with tax in that one line item, then you can do it all in one. Okay, so tax on land. Okay. Okay, so this is going to be equal, always be in the opposite direction of that number. We only include 80% and multiplied by 28%. Okay. Okay, so that is the fair value on land. Okay. Next, we go to the next line item. On 1 March, bottles sold computer equipment to Cooldrink Bottles initially purchased this computer equipment on 1 September 2020 for an amount of 165,000 Rand. Cooldrink paid an amount of 170 for this equipment and will depreciate it over the remaining useful life. So Bottles made the sale. So the profit is sitting in Bottles' book. So therefore, we're going to make the adjustment in the books of Bottles. If it was other way around, if the parent sold to Bottle, then we would make the adjustment in the books of the parent. So that's very important. It's important to understand whose books must be adjusted. In this case, must be Bottle's books that needs to be adjusted. What I'm trying to also say is, even if it was in the books of Cooldrink, go adjust the books of Cooldrink immediately, so you don't have to come back to reread this part. Okay, so let's go and have a look. So in the books of, so there was a sale of equipment. So we need to eliminate the profit on the sale as well as the additional depreciation that Cooldrink is recognizing. Okay. So let's have a look over here. So if I go back, so I'm gonna have another working. So let's do the working over here. So working 6. Okay, so what are we doing? We're doing the following. I'm going to say consideration. Okay, so it was 170. Okay, then we're going to compare to carrying value. Okay, I'll just write out full carrying amount. Okay, carrying amount is costs less accumulated depreciation. Okay. Okay, so to work out consideration, to work out profit or loss on this land, we're going to say profit or loss on sale. It is basically consideration minus carrying amount. Okay, now we know consideration is 170,000 Rand. We know cost price is 165. Oh, sorry. No, cost price is 165,000 Rand. All we need to do is calculate accumulated depreciation. By calculating accumulated depreciation, we'll be able to calculate carrying amount. So let's go back to the scenario. So on 1 March 2021, Bottles sold computer equipment which they acquired on 1 September 2020. Okay, so 1 September 2020 is the beginning of the current financial year, because remember, our financial year is ends 31 August 2021. So the beginning is 1 September 2020. So 1 September 2020 up until 1 March is about 6 months. Let's count. So September, October, November, December, January, February. So that is 6 months. At the bottom of the scenario, under additional information, that tell you equipment is used over 3 years. Okay, so to work out accumulated depreciation, it would simply be 165,123 divided by 3 years, because that is the useful life. And then we're going to say multiplied by 6 divided by 12. So we're going to say equal 165,123 divided by 3. That's annual depreciation. But we don't have it annually. We only have it for 6 months, so multiplied by 6 divided by 12. Okay, so if we say cost minus accumulated depreciation, we get the carrying amount. So consideration minus carrying amount will give us a profit of 32,500 Rand. Okay, so that is basically the profit. Okay, now As a result of this profit, there will be additional depreciation. As a result of this profit that the entity that the subsidiary made, um, the parent will be paying additional depreciation on that profit. So to work out the depreciation, additional depreciation by the parent would be it would be okay, so it would be profit on sale, which is a 32,500. Then we will calculate remaining useful life. So remember, the remaining useful life is going to be as follows. The total useful life of the equipment is 3 years. Okay, six months have passed. So therefore, the remaining useful life would be 2.5 years. Okay, so we will just say equal. So it will just be basically be 2.5. So that means annual depreciation. So annual depreciation is equal to the profit that the extra, so the profit, that profit that the subsidiary is making, that is ultimately leading to additional depreciation that the parent is recognizing. So we just say profit divided by the remaining useful life. So annual depreciation is 13,000. But we never had it for a full year. So therefore we say depreciation for the year. Okay, so it's going to be 6 months. Only used it for 6 months because they acquired it on 1 March and the financial year ends 31 August. Okay, so therefore it will be equal to 13,000 multiplied by 6 divided by 12. So that means, what do we have to do? Included in the profit of bottles is a profit of 32,500 Rand. So the bottles profit is overstated by 32,500 Rand. So therefore, eliminate unrealized profit on equipment. Okay, you don't have to write it so long. You just say profit on equipment. I'm using the word eliminate just to add some understanding, but you can just say equipment. Okay, or you can just say unrealized profit on equipment. Okay, so we want to eliminate it. So it's a 32,500. I'm going to tell them, look to working 6. Okay, so just in case it is not correct, then I can see where I went wrong, so I can get my part marks. If I got this wrong and I don't put the working, I'll get 0. But if I get this wrong and I put the working, they can at least give me part marks up to the point where I got it right. Okay, then so that is the first part. The second part is the parent's depreciation is overstated. Now, take note, the parent's depreciation is overstated. That means the expense is too much. Because the expense is too much, the profit is too low. So what do we have to do to profit? We have to increase profit as a result of that additional depreciation. Now, what's important, the depreciation, the extra depreciation is in the books of the parent. But in terms of accounting, that depreciation we bring in by in the books of the person who made the profit. So because the subsidiary made the profit, we bring in the depreciation in the books of the subsidiary. So therefore, we're going to say eliminate additional depreciation. Okay, so we want to increase profit as a result of that. So we will just say 6,500. It's going to increase. Now we'll bring on the tax on this. Okay, so if you want to, I will show it separately just to make it easier for everyone. So I'll say tax on profit of equipment. Tax on depreciation. Okay, so just say opposite direction multiplied by 28%. Opposite direction multiplied by 28%. Okay, so that is basically the that should be the final profit. There's nothing else. So actually, let me just go and go back. So there is one more thing. So we dealt with everything over here, but there is one more thing. It is this. Okay, management fee. So this has the same concept as the rental income. So Bottles is paying a management fee of 211,000. So in the books of Bottles is a management fee expense of 211. In the books of Cooldrink is a management fee income of 211. Because we are calculating the impact on profit, so we don't have to make the adjustment. If we were doing it line by line, other income, other expenses, then we would have to make the adjustment. Okay, so just take note of that. So therefore, I'm not going to bring this in. There's no need. Okay. So if we add up everything, so this is going to be profit for the year, and I make it clear to myself, group perspective. No need to do this. I'm just doing for myself. If you want to do it, you obviously can. Okay, so that should be the profit from, so this is C36. So I'll go here on top, and I'll go equal C36. Okay, so there we go. If I add this up, and it will be this amount. Okay, so if I go to sheet 1, there we go. The amount is there. Okay, so if I run out of time, I at least have some amount in, I can get some part marks. Okay, but obviously that's not the whole objective. The whole objective is that you want to get everything done. Okay, so the next one is do slim water, and then we will do Cooldrink. Okay, so we do the exact same thing with regard to slim water. Work out gross profit, other, we work out that. Okay, so if I go back over here, slim water is the last column. So gross profit is that. There's no other income. Okay, so there's no other income. Now we need operating expenses and income tax. So operating expenses is this, income tax 208,020. Okay, so 208,020 negative 208,020. Okay, operating expenses. Okay, so 632,980. Okay, so that is the total profit of the associate. Okay, 100% of the associate. Now, remember, we don't want the profit of the associate from a separate trial balance point of view. We want profit from the associate from a group perspective. Okay, so that's important to take note. So the only time that the profit from a separate trial balance point of view is different from the profit and loss from a group perspective is if there are any group adjustments. Now, once again, the way I think about it, that there are two types of group adjustments. Group adjustments relating to at acquisition transactions, group adjustments relating to intercompany transactions. Okay, so let's have a look if I have any. So if I go to Slim Water, so here we have Slim Water. Okay, so there you can see Cooldrink purchase 25%. Okay, we see all of that. Then we have all the assets and liabilities were fairly valued. from 20, okay, so here we have, okay, so from 2020, Slim Water sold water to Cooldrink. Okay, so Slim Water sold to Cooldrink. Therefore, the profit is sitting in the books of Slim Water. Okay, so there's unrealized inventory. Okay, so let's have a look what to do with that. Okay, so there's an opening inventory of 77,000 and a closing inventory of 91,000. Okay, so what we're gonna do, unrealized profit in closing stock. Okay, I'm gonna just call it text on above. Um, um, yeah, so make it clear over here. And then here we're gonna recognize unrealized profit in opening stock. Okay, so what's important to take note when it comes to opening inventory, remember when we're dealing with group accounting, we prepare pro forma journal entries to consolidate financial statements. Okay, so when we do group accounting, we use pro forma journal entries to consolidate the financial statements. Okay, now one of the important principles when it comes to group accounting is that we prepare pro forma journal entries from scratch every single year. Okay. Now, the opening inventory of last year, the opening inventory of this year was last year's closing inventory. Now, we all know when we have unrealized profit, including in closing stock, we have to eliminate it. Now, because we are what can I say now? Because we are reproducing the pro forma journal entries from scratch, what happens is this this opening balance of this year was last year's closing balance. Now we have to reproduce last year's closing balance. So what do? We do recognize, we do eliminate the closing stock in last year's we do eliminate the unrealized profit in the closing stock of last year's closing balance. So we do that. But at the same time, we recognize we then recognize the unrealized profit in opening stock. So let me just show you the journal entry that gets processed. Okay, so this is purely relating to opening the unrealized profit, including in opening inventory. Last year, what would have happened? Okay, so I'm going to use that actual numbers. Last year, so at 31 August 2020, at 31 August 2020, we'd have done the following: eliminating the unrealized profit included in closing stock. So this is what we'd have done. Because closing stock is overstated with that unrealized profit, we need to eliminate it. By eliminating the unrealized profit, we are decreasing inventory. By decreasing inventory, so because inventory is an asset, that means we are decreasing an asset. An asset decreases on the credit side. So we will say credit inventory, SFP, and we're going to put the amount over here, which would be 77,000 Rand multiplied by the unrealized profit of 40% divided by 140. Because it is on cost, it is 140. So the answer over here would be 77,123 multiplied by 40 divided by 140. So the unrealized profit is 22,000 Rand. Okay. For every credit, there must be a debit. For every credit, there must be a debit. The debit last year went to cost of sales. Okay, so cost of sales, P&L, going to be the same amount. Okay, so that is that was the journal entry that was done at 31 August 2020. Okay, so this year is 31 August 2020. Now we are in 2021. So 31 August 2021. In the current financial year, we need to prepare pro forma journal entries. And that means we need to prepare pro forma journal entries from the date of acquisition up until now, meaning from scratch up until now. So every single year, we reproduce journal entries from scratch. We reproduce journal entries, pro forma journal entries from the date of acquisition up until the end of the current year. So this year in 2021, we need to reproduce this journal entry. Okay, so what's going to happen? We're going to reproduce this journal entry. But now, this journal entry relates to last year's closing balance. This journal entry relates to last year's closing balance. And as a result, we can't call that cost of sales because last year's cost of sales no longer exists. Where is last year's cost of sales? Last year's cost of sales has been written off to retained earnings. So therefore, we have to call this retained earnings. Okay. Now, last year's closing balance is this year's opening balance. Last year's closing balance is this year's opening balance. Now remember, cost of sales equals opening inventory plus purchases minus closing inventory. Okay, so that is cost of sales. Opening inventory, opening balance inventory plus purchases minus closing balance inventory. Okay. Now, last year's closing balance is this year's opening balance. So, by virtue of this formula, it is assumed that the opening stock has been sold. It is assumed that the opening stock has been sold. Because opening stock has been sold, that means the unrealized profit included in opening stock should be realized. So that is why we are saying now, we need to now realize that the opening inventory. So what do? We need to decrease cost of sales. By decreasing cost of sales, we are increasing profit. That's what we want. We want to increase profit. So therefore, we're going to decrease cost of sales. Cost of sales decrease on the credit side. So we're going to say credit cost of sales with the exact same amount. For every credit, there must be a debit. The debit will go against inventory. Now remember I said, we are assuming that the opening inventory has been sold. Okay, because opening inventory has been sold, the unrealized profit included in opening inventory needs to be realized. Now we have already removed it over here. So then to recognize it, we capture it over there. Okay, so now we are square. Okay, so we're happy with that. If opening inventory has not actually been sold, we will just capture it by this year's closing balance. So that is why we are doing it. I don't know what's happening here. So it's P&L. So for every debit, there must be a credit. Okay, so that is basically what's happening over here. So all we are doing is we are realizing the unrealized profit, including an opening inventory. That's all that we are doing. So that is why I'm calling it recognize unrealized profit in opening stock. So all I'm going to say is 77 times 40 divided by 140. Okay, so because I'm realizing it, we want to increase profit, so we leave it positive. Okay. And then over here, it was 91,000. So we can say 91 times 40 divided by 140. Okay, so we want to eliminate it. So we say equal to negative 91 times 40 divided by 140. Once again, you can group them together. I'm just showing them separately because I know there's a few people that prefer it separate. So we're just doing it like that. Okay, so that is basically that one over there. Then we have during the financial year paid management fee, same story as the 211. So I'm not going to go through that. Okay, Slim Water. Okay, so that is mark-to-market reserve. That will be included in other comprehensive income. So this will be included in other comprehensive income. So we won't deal with it now. Okay, then they say on 31 August 2021, Cooldrink disposed of 20% interest in Slim Water for 1.6 million. The remaining 5% interest had a fair value of 290. On 31 August 2021, Cooldrink classified the remaining investment as a financial asset at fair value through other comprehensive income. Okay, so let's just go see what's happening here quickly. So this is in the books of Cooldrink. Okay, so we can adjust the books of Cooldrink. So let's see if we can find any equity at 31 August 2021. Okay, so here's a trial balance at 31 August, so we can use that to get net asset value. Let me just see what we tried to use here. Is anything else? Cooldrink purchase shares. Okay, so there's nothing else over here, so that's fine. So now let's deal with this aspect over there. Okay, so now let's deal with this aspect over here. So there's nothing more in the books of Slim Water. Okay, so we can work this out. We're still going to deal with that aspect. Because what I want you to know that immediately if it impacts the parent, go do it in the parent's books. Okay, so let's go and deal with that. But let's first work it out. There's nothing else, so we can just do this. Okay, so now do that. Okay, so that is basically the books of the parent. I mean, that is the profit for the year for Slim Water from a group perspective. But we want now our portion, share of associates profits. Okay, so 25%. I'm going to say that multiplied by that. Okay, so that is our percentage. Okay, so all I'm going to do, this is C49. I'm going to go to the top and I'm going to say equals C49. Okay, what I want you to see quickly something is that Slim Water is working 5 and Bottled is working 4. Okay, so what you want to do, plug it in, because if it is wrong, then they can go see. If it is wrong, then they can go see where those numbers are coming from. Okay, so if I just do that, there we go. So if it's wrong, then they can immediately see where to go and look. Okay, so if I go over here, if the number is wrong, they come to working 1. When they go to working 1, they can see this. Okay, Then they're like, okay, but that number is wrong. So let's go. Where can I see this number? Working for. Then they go to working for. So it's easy for them to follow. Okay. So there we go. Now I want to do Cooldrink. Okay. So now I want to do Cooldrink. I'm going to do the exact same thing when it comes to Cooldrink. I'm going to take that. Okay. Let's make a few lines. So now we need to go fix up Cooldrink's profit. Okay. If I go to Cooldrink's profit, so if I go to Cooldrink's profits, we'll start with gross profit. It'll be this one over here. So there's 1,708,750. 1,708,750. So this for Cooldrink is 1,708,750. This over there would be that. Oh, no. Okay, then we need operating expenditure, which is this. And the income tax is 538,750. 538,750. 538,750. Okay, then we have this over here. Okay, so that is the profit for the year. Now remember the difference between, so now the difference between the profit, so the difference between the profit from a separate trial balance and the profit from a group perspective is if there are any group adjustments. Okay, so the group adjustments would be as follows. Okay, so the group adjustments would be as follows. What are the group adjustments? There are two types as the way I think about it, and that is group adjustments relating to acquisition transactions, group adjustments relating to intercompany transactions. Now, there was no intercompany transactions from the group, from a parent's perspective. Okay, there were intercompany transactions, but it happened in the books of bottles, it happened in the books of Slim Water. Okay, but there wasn't anything from the parent's perspective. Okay, but what is there from the parent's perspective is that change in ownership relating to Slim Water from an associate to an ordinary investment. So we need to account for that. That would be impacted in the books of Cooldrink. But before we get that, before we do get into the obvious ones, what you want to make sure is you do first is to adjust for intercompany dividend income, because it's so easy to forget this because it's not mentioned explicitly. Okay, so I always do this first because it's easy marks, and I always tend to forget it if I do all the other stuff that I can see, because then I forget about this one. So what do? I immediately put in intercompany dividends. Okay. Again. Okay, so it would be Cooldrink. Cooldrink, we have 60%. Okay. Then we have 80% of bottles, and we have 25% of whoever it was. Okay, Slim Water and bottles. Okay, so the way we find this, we go to the balance, the trial balance, and there we can see Cooldrink declared 400,000, bottles declared 130, and Slim Water declared 100,000. So all I'm gonna go Cooldrink times 400, 1, 2, 3. Okay, Bottles, 80% times 130, 123. And them times 100,000. Okay, so I want to eliminate it. So I'm going to say equal negative 100, 123 times 25%. This one equal negative 80,000, 80%. Can we just say 130 times 80%. Then for Cooldrink, they declare this on 31 August 2021. This 400,000 is in the foreign currency, so I need to go find the exchange rate at 31 August 2021. So the exchange rate at 31 August 2021 is as follows. Here's an additional information. Here's here, they told you all group dividends were declared at year end except for Slim Water. Okay, so 31 August 24. Okay, 24. Okay, so I'm going to do that. I'm going to say multiplied by 0.24. Okay, so for CTA level 1, you wouldn't include this one because you wouldn't have the foreign sub. Okay, for CTA level 2, you have the foreign sub, so you will include this. Okay, so so what I'm going to do, I'm going to leave this one out for now. Okay, because I want to show the CTA 1 students what their answer would be without Cooldrink. Okay, so I'm going to highlight this so I don't forget about it. Okay, so there we go. So this will be 0.24. Okay, so I will add that number in afterwards when I go through the foreign sub. Okay, so I'm highlighting it in orange so I don't forget it. Okay, so now I know dividend income, which was easy mark, but easy to miss because it's not explicitly there. That's why I'm bringing it in. Now, what I want to deal with over here is that of Slim Water. Okay, so the parent had 25% in Slim Water. Okay, then on 31 August 2021, the last day of the current financial year, they disposed of 20%. So what they would have done is as follows. They would have what the parent would have done is the following. They would have de-recognized 20% of their 25%. Okay, so included in the parent's profit is a profit or loss on the disposal of 20% of Slim Water. The group don't want that profit. The group want to calculate it in a different manner. So let's have a look how we would go about calculating this. So I'm going to do a working 7, I suppose. Yeah, working 7. Okay, working 7. I'm going to call this details. I'm going to say separate TB. And then I'm going to say group TB. Okay. I'm not going to, I'm just going to call it group. So I'm going to say consideration less carrying amount. When we dispose of an asset, we dispose of a carrying amount, and then this will give us profit or loss. Okay, so this would give us profit or loss. Profit or loss on disposal. Okay, so now let's have a look. If we go to Slim Water, we want to find out how much did the parent sell Slim Water for. So here you can see on 31 August, Cooldrink disposed of 20% in Slim Water for 1.6 million. So they physically sold for 1.6 million. Okay. 1.6 million, 1, 2, 3, 1.6 million, 1, 2, 3. Okay. So that will remain the same. Now we need to work out carrying amount. Okay, so how the parent have worked out carrying amount. So the simple way the parent would have worked out carrying amount is to take its original costs So the original cost when they bought it was 1.1 million. They paid on 1 April 1.1 million. So they'll just take this 1.1 million, multiply by 20 divided by 25. So all their work out is as follows. Okay. I'm gonna take a long route. You don't have to do working 8. I'm just taking a longer route so you can see what's happening. Okay. So carrying amount. Okay, so I'm gonna say cost. Okay, 1.1 million. Okay, percentage disposed of relative to total. Okay, so what they would work out is they're saying we are selling 20% out of our 25. Okay, so they're selling 80%. Okay, so just take note of that. So therefore, carrying amount disposed would be 1.1 multiplied by 80%. Okay, so that is what they are disposing of. So their carrying amount would equal that. So the profit they have worked out is 1.6 minus 880. So the profit they in the separate TB is 720. So in the books of bottle, included in Cooldrink's profit is a profit on the 20% disposal of slim water of 720. The group don't want that 720. So therefore we're going to say eliminate profit on disposal of slim water. Okay. On disposal of profit, eliminate profit on disposal of 20% of slim water. Okay, I'm just being a little bit more detailed. You don't have to write all these words, because you obviously don't have, you are limited for time. So this was equal to C, I don't know, let's go fetch it. There we go. Okay, so included in the profit is a 720. It increased the profit. We want to eliminate it, so therefore we decrease it. Okay. So what do the group want to recognize? The group want to recognize profit on disposal from group perspective. Okay, so it must be the group perspective. We'll call it consolidated profit, or whatever you want to call it. Okay, so now how the group work this out. Okay, so here's a slight nuance over here when it comes to the group. So remember, here this is a change in ownership. Okay, so this is a change in ownership. When there is a change in ownership, and the change in ownership results in a change in the type or nature of investment. So it went from associate to a normal. That is a change in a type of the investment. So according to IFRS, when that is the case, you are deemed to have disposed of your entire investment. Remember, we actually only sold 20 out of 25. But because that change in ownership resulted in the change in the nature of the investment, meaning the type of investment, it went from associate to normal, we are deemed to have disposed of the full investment. So we only sold 20 out of the 25. So how do we account for the remaining 5%? The standard says account for the remaining 5% at fair value. So we assume we sold, so fair value of remaining 5%. So we assumed the consideration would be equal to the fair value thereof. Okay, so this would be that in the scenario they told us this was 290. Now you need to work out the carrying amount of, now we need to work out the carrying amount of, we need to work out the carrying amount of the investment from a group perspective. Okay, so let's have a look. How would we work that out? So when it is from a group perspective, we generally want to work out what is the investment in associate. We generally want to work out what is the investment in associate at 31 August 2021. Okay, so what is the investment in associate at 31 August 2021? So that is basically what we need to determine. What is the investment in associate at 31 August 2021? So let's see, we can see what would be the investment in associate at 31 August 2021. Okay, so to continue with calculating the carrying amount of, to calculate the carrying amount of the associate from a group perspective, we'd want to determine what is the investment in associate as at 31 August 2021. So that is what we're looking for. Another way is to work out the consolidated, is to work out the net asset value of the associate as at 31 August 2021. So what we can do, they gave us information to determine. They gave us the information to determine. So I'm going to say working 9. I'll take the trial balance, the balance sheet of the associate at 31 August 2021. So for example, if I scroll up over here, if I scroll up, what did happen over, where is it now? Yeah, so I can take this balance sheet over here, and that would allow me to determine the net asset value at 31 August 2021. So I will take, so here we have deferred tax, so 85,620. So let's just do that. Tax, so 85,620. It is a credit balance as a liability. Then we have trade and other payables, which is this amount over here. Trade and other payables. Oh man, what am I doing? Okay, and then we have, then I'm going to take plant and equipment. Plant and equipment. Okay, then we're going to take other equity investments, 395. So other equity investments, and then I also saw trade and other receivables. Okay, so it was 395. Then it was 422. Okay, what was the last? I don't think that was the last one. And then we have, that was inventory. And then, okay, so inventory was that. Trade other receivables is that. Then we had inventory. Okay, 422. Okay, the last thing is there anything? Cash and cash equivalents. Okay, 962. Okay. 962. 962, 1, 2, 3. Let me change that to negative and that to negative. Okay, there should be net assets. Assets minus liabilities equals net assets, which is basically equal to equity. Okay, so I'm going to say equal sum. Okay, so there we go. So this is the console. It needs to be from a group perspective. So this is the amount from a group perspective. So therefore, net asset value, we have 25%. 25%. Our percentage is equal to that times 25%. Okay. What's important to take note, we must take in goodwill as well. So take goodwill into account. Okay. And to work that out, we paid 1.1, 123 minus at the date of acquisition, the net assets was 3.6 million and we acquired 25%. So if I say equal 1.1, 123, 123 minus open bracket 3.6 million times 25%, it's a positive, what is this? Okay, so there we go. So if I say sum, that would be our carrying amount as at 31 August 2021. Okay. Tell them they can look at working 9. So what the group wants is basically the sum of that. Okay, what happened? Undo. I'll make this negative. So that is the group profit. So what the parent had in the separate books was 720. What the group wants is 104. You can take the difference, but I prefer eliminating the group profit, the one that is actually the one that is included in the parents' books, and then recognize what the group actually wants. Okay, so that is D81. So when I go over here, Cooldrink, and I'm going to say equal D81. So we eliminated what is included in the parent's profit. We don't want that, and we include what the group actually wants. Okay, you could have taken the difference, which is 615,295 over here at the bottom. 615,295. You could have taken that. Up to you. Does not matter. Okay. The last thing to take note is as follows. Okay, so the last thing to take note is as follows. So let's see that was working 7. So I'm going to tell them they can go look at working 7 over here. Working 7, working 7. So if it was wrong, they can go see where we went wrong. Okay, now what we want to do is the following. So what you should understand, I'm going to do here working 10. The fair value of remaining interest, the fair value of the remaining interest was 290. Okay. Carrying amount, I'm going to just do the fair value of remaining interest. I want to change this to carrying amount of remaining interest. Carrying amount of remaining interest. It must be of. Okay, that must be of. Okay, is as follows. Okay, so remember the carrying amount was 1.1, 1, 2, 3. The remaining interest is 5 divided by 25. So what I'm going to say equal 1.1, 1, 2, 1, 2, 3 times 5 divided by 25. The remaining interest is 290. So the gain that the parent would have recognized is the difference. Okay, the gain the parent would have recognized is difference. Gain, it is the 90,000 or whatever this is, 70,000 Rand. So the parent would have recognized the 70,000 Rand in the parent's profit. Okay, the parent would have recognized that 70,000 Rand in the parent's profit. But what you should know is that because the group is recognizing it at fair value through other comprehensive income, that gain cannot be included in profit or loss. That gain needs to be included in other comprehensive income. So that we're just going to call it reclassification of gain on remaining interest. Okay, so that 70,000 Rand would have been recognized in profit or loss, correctly recognized in profit or loss. But we don't want it in profit or loss. Where must it be? It must be in other comprehensive income. So therefore, we're going to reclassify it from profit or loss to other comprehensive income because it's not correctly included in over here. It should be in other comprehensive income from a group perspective. Okay, so that will be the total for Cooldrink's profit from group perspective. Okay, so remember we must still bring in pink, but I'm going to do pink, the foreign sub, in a separate video and then adjust these numbers as we go along. I'm leaving it, the reason why I'm doing it like this, so that the CTA1 students will be able to see the difference, okay? So if I do that, that would be the group's profit, the parent's profit from a group perspective. This is going to change once we bring in pink. Okay, so that is C24. So if I go over here, I'm going to say equal C24, and then there it is. So now my profit is 5.2 million, and there we go, 5.2 million. For CTA1, this would be your answer. For CTA2, this is going to change once we bring in pink. Okay, but I'm going to do pink in a separate video, which is a bit lengthy. Okay, so that is basically profit for the year. The only thing we need to deal with is other comprehensive. Okay. Now let's continue with other comprehensive income. Now, other comprehensive income, we're going to have revaluation on land, and we're going to have share of associates, other comprehensive income. Other comprehensive income. Okay, this part we're not going to deal with because it's related to the foreign sub, so we'll deal with that part when we deal with the foreign sub. Okay, so just take a note of that. So remember the gain on the land. If we go to this workings over here, the gain on land was somewhere under bottles, I think. So there we go. There is the gain on the land. Okay, there it is. So that answer of 62,080, that will simply be, so I just want to put it over here so that we don't do a separate, what do you call it, revaluation on land net of tax. So remember, that land was classified as fair value, as investment property, so the fair value gain goes through profit or loss. From a group perspective, the land is PPE, so the fair value gain cannot go through profit or loss. It needs to go through other comprehensive income. Okay, so that is simply going to be that sum over there. Okay, so I'm going to highlight it like this so it is easy to see. Okay, so then I'm going to say equal, bring it in over there. Okay, it needs to be positive, so I'll just change the sign because it is a gain, so it needs to be positive. Okay, so this was in working 4. And then the share of associates' profits. So what's important to take note, there we have mark-to-market reserve. Okay, so the mark-to-market reserve is sitting over there. So because it is mark-to-market reserve, it's an equity account. It is already net of tax. So we simply need to take our portion of this. We simply need to take our portion. This amount is already, because it's sitting in an equity account, mark-to-market reserve, that account is already net of tax. So we simply take it, we simply take that amount. Okay, so it's simply going to be 58,200 times 25%. Okay, this 58,200 is already net of tax because it is an equity, because it is a SCE amount. Okay, so when it's already in the statement of change in equity, it's already net of tax. So we're simply going to say 58,200 times 25%. So some of you might be asking me, why are we not excluding that mark-to-market reserve? So what's important to understand, we only exclude a mark-to-market reserve if it relates to an associate, if it relates to a subsidiary or so forth. This mark-to-market reserve does not relate to an associate or anything of that nature. It relates to this over here. Okay, so Slim have a normal investment. Slim have a normal financial instrument that is measured at fair value through OCI. So therefore, we recognize we can share in that profit. This is a normal investment. So therefore, we bring in that mark-to-market reserve. Okay, so that would simply be it. Okay, so there we go. Okay, so they wouldn't have anything over here. CTA level 1 wouldn't have anything over here. We will adjust that when we do pink. So if I add up, it will be, if I add up, it will equal that plus that. So total other comprehensive income is 76. Then total comprehensive income is that plus that. Okay, so I'm going to stop over there. When I do the next video on pink, then I'll explain how we would split this number. I'll get to the number we need from a CTA 1 level as well as a CTA level 2. Okay, so that's it for this video. So in the next video, I'll do pink, the foreign subsidiary.